Thanks for watching. If you like our channel, please subscribe now. Then you will not miss any videos in the future. What do you think are the key business fundamentals that Warren Buffett focuses on? If you're a fan of investing, you've probably heard of Warren Buffett, the Oracle of Omaha, whose investment philosophy has made him one of the wealthiest individuals in the world. His approach isn't about predicting short-term market movements or chasing the latest investment fads. Instead, Buffett emphasizes the importance of focusing on business fundamentals. He believes in truly understanding the businesses in which he invests. This includes getting to grips with their business model, operations, competitive advantages, and management team. It's about looking for strong, simple, and understandable businesses that have a long-term perspective and offer predictable cash flows. And importantly, it's about finding companies that are undervalued, providing a margin of safety for investors. So, are you ready to explore the key aspects of Buffett's focus on business fundamentals? Let's dive deeper into these key aspects of Buffett's focus on business fundamentals. Firstly, understanding the business is crucial for Buffett before any investment. This isn't about just knowing the company's name or what industry they're in. No, it's about going deeper, peeling back the layers to really grasp the core of the business. It's about knowing the ins and outs of their business model. What is their revenue source? How do they operate? What makes them unique? Buffett doesn't just stop there. He also looks closely at the company's competitive advantages. What does this business have that sets it apart from others? Is it their brand strength? Or maybe it's their patents or regulatory barriers? Whatever it is, Buffett wants to know. But understanding the business doesn't end with the model and competitive advantages. It extends to the management team as well. Buffett places significant importance on the quality and integrity of those at the helm. He looks for leaders with proven success, who act in the best interest of shareholders and who allocate capital wisely. And here's the kicker. Buffett prefers businesses with simple and understandable models. Why? Because they're easier to predict and evaluate. If a business is too complex or hard to understand, it's more likely to be unpredictable, and therefore a riskier investment. So, understanding the business forms the foundation of Buffett's investment approach. It's the first, yet one of the most vital steps in his philosophy. Secondly, Buffett seeks businesses with a durable competitive advantage. This term might sound fancy, but it's really just another way of describing a company's economic moat. This concept, borrowed from medieval times, encapsulates the idea of a business being able to defend itself against the onslaught of competitors, much like a castle with its protective moat. An economic moat can take on many forms. Some businesses have a strong brand presence. Think of the global recognition enjoyed by companies like Coca-Cola or Apple. Others benefit from scale advantages, where their sheer size allows them to outperform smaller competitors. Patents, regulatory barriers, or network effects are other forms of an economic moat. Take, for instance, a pharmaceutical company with a patented drug. This patent protects the company from competition, allowing it to set prices and recoup research and development costs. Similarly, a tech company with a strong network effect like Facebook or LinkedIn becomes more valuable as more people use it, creating a barrier for newcomers. What's important to understand is that these moats give companies the ability to maintain profitability over the long term. They fend off competition and allow the business to generate consistent earnings. This durability is what Buffett looks for. It's not just about today's profits, but the capacity to sustain these profits year after year, decade after decade. This long-term profitability is what ultimately drives a company's value. A durable competitive advantage, therefore, is a key aspect of Buffett's investment criteria. Thirdly, Buffett favors companies with predictable cash flows. Now, what does this mean? Well, it's all about stability. Picture a stream of income that flows steadily, with minimal fluctuations. That's what Buffett seeks. Why? Because this consistency allows him to estimate future earnings with more confidence. Imagine you're planning a picnic. If you know it's sunny all week, you can plan with certainty. But if the weather is unpredictable, you're left in a state of uncertainty. The same principle applies to investing. Predictable cash flows reduce the risk of investment losses due to unexpected downturns. It's like having a financial weather forecast, providing a clearer picture of a company's financial future. So, when Buffett examines a company, he's looking for that steady stream, that predictable cash flow. It's a sign of a healthy, reliable business. Predictable cash flows, then, are another important factor in Buffett's investment decisions. Fourthly, a quality management team is vital to Buffett. Now let's break down why this is so important. A company, no matter how great its business model or competitive advantage, is only as good as the people who run it. It's the management team that sets the direction of the company, makes crucial decisions, and ultimately guides the company towards its goals. Buffett doesn't just look for any management team, though. He seeks out teams that have a strong track record of success. Experience, after all, is often the best teacher. A management team that has proven its ability to navigate the ups and downs of the business world and come out on top is a valuable asset indeed. But it's not just about past success. Buffett also pays attention to how the management team acts in the present. Specifically, he looks for teams that act in the best interests of shareholders. This means making decisions that will enhance shareholder value, not just in the short term, but also in the long term. Lastly, Buffett values wise capital allocation. The management team should be investing the company's resources in a way that will yield the best returns. This might mean expanding into new markets, investing in research and development, or improving existing products and services. Quality management, hence, is a critical element of Buffett's investment philosophy. It's one of the key factors that can set a company apart from the rest and make it a worthy investment. Lastly, Buffett's long-term perspective and adherence to value investing principles are fundamental to his approach. Now let's unpack this a bit. You see, time is a crucial element in the world of investing. Warren Buffett isn't a man to rush decisions or jump at short-term gains. Instead, he takes his time, allowing his investments to grow and compound over the years. This is what we call a long-term perspective. It's about seeing the bigger picture, understanding that the true worth of an investment often unfolds over time. And it doesn't stop there. This long-term perspective goes hand in hand with Buffett's commitment to value investing principles. Now, you might be wondering, what exactly is value investing? Well, in simple terms, it's about finding and investing in companies that are, for lack of a better term, on sale. These are companies that, for one reason or another, are trading at a price that's less than their intrinsic value. But how does one determine this intrinsic value? It's not as elusive as it sounds. It involves looking at a company's fundamentals, including its earnings, assets, debts, and overall financial health. The goal is to find companies that are undervalued by the market, offering investors a chance to buy shares at a discount. This is where Buffett's focus on business fundamentals truly shines. He looks beyond the current market price, digging into the nitty-gritty details to assess a company's true worth. So it's a combination of patience and keen analysis. A long-term perspective allows Buffett to weather market fluctuations, while value investing principles guide his selection of investments. He's not swayed by the latest trends or quick wins. Instead, he stays focused on the fundamentals, looking for solid businesses that will thrive in the long run. A long-term perspective and value investing principles thus complete the picture of Buffett's focus on business fundamentals. Let's summarize what we have discussed about Buffett's focus on business fundamentals. First, understanding the business is paramount. Buffett dives deep into a company's operations, competitive advantages, and management team before deciding to invest. He favors businesses with straightforward models he can readily grasp and predict. Second is the concept of durable competitive advantage, or economic moats. Buffett is drawn to companies that have a sturdy shield against their competitors, which could be their brand strength, network effects, or any other edge that is hard to replicate. Then comes predictable cash flows. Consistent and stable earnings are Buffett's cup of tea, as these allow him to gauge future earnings with greater certainty and minimize the risk of investment losses due to unexpected downturns. Quality management also stands out in Buffett's checklist. He values management teams that have a proven track record, act in the best interests of shareholders, and allocate capital wisely. Buffett's long-term perspective aligns perfectly with his focus on business fundamentals. He invests in firms with the intention of holding them for many years, allowing them to grow and compound their earnings over time. Lastly, he sticks to value investing principles, seeking out companies trading at a discount to their intrinsic value, thereby providing a safety net for investors. These key aspects underscore Buffett's belief in the importance of investing in quality companies with strong competitive positions and excellent long-term prospects, and have been a key driver of his success as an investor.